Warren Buffett, 10 mistakes every investor makes. Market crashes, frustrated traders, uncertainty at every turn. In the chaos of the financial world, one name stands out as a beacon of wisdom: Warren Buffett. But even the Oracle of Omaha wasn't immune to mistakes. Today we're unveiling the top 10 mistakes every investor makes, illuminated by the timeless insights of Buffett himself. If you're new here, like the video, subscribe to the channel, and press the bell icon to get instant notification of our upcoming videos. Let's get started. Number 10. Fearing mistakes. A universal fear grips many investors: the fear of making mistakes. No one likes seeing their hard-earned money disappearing due to a wrong move. But even the great Warren Buffett isn't exempt from this. Over his illustrious career, he's made choices he later regretted. "I've made plenty of mistakes. The thing is, they haven't discouraged me," Buffett said. But there's a lesson here. It isn't the mistake itself, but how he responds to it. Fearing mistakes can paralyze an investor. It can stop you from taking risks or making decisions, ultimately stunning growth and potential gain. What's essential is to view mistakes as lessons and learning experiences that shape and refine your investment strategy. While one investor drowns in regret, another uses the opportunity to learn, adapt, and prepare for the future. The rearview mirror is always clearer than the windshield. Understand the past, but always drive forward. Number 9. Not reviewing your portfolio. Imagine a garden where some flowers bloom brilliantly, while others wither away, all because the gardener tends to only one section, neglecting the rest. The garden mirrors many investors' portfolios. In the ever-evolving world of finance, time doesn't stand still. Investments that once flourished might now be stagnant, and overlooked sectors today might be tomorrow's gold mines. One of the secrets of Warren Buffett's success is his discipline in regularly reviewing his investments. Just as a gardener prunes, waters, and repositions plants according to the changing seasons, so should an investor with their portfolio. Economic conditions, business models, and industry innovations change. If you're not routinely checking on your investments, you might be holding on to sinking ships or missing out on the next big thing. Ignorance isn't bliss in the investment world. A passive approach can cost you, while an active, informed strategy can yield better results. To take a cue from the Oracle of Omaha, frequently review, reassess, and realign your portfolio. Adapting to the financial tides will lead you to a prosperous financial future. Number 8. Forgetting about intrinsic value. At first glance, the shiny vase might seem like the prize. But what if the vase is brittle, while the unassuming pot has been crafted from a rare, durable clay? In the investment world, the allure of surface-level appeal often overshadows true value. This is where many stumble, forgetting about intrinsic value. Warren Buffett's legendary success hinges on his unwavering focus on intrinsic value. It's not about how a stock is performing today, but the fundamental worth of a company. Intrinsic value considers a company's tangible and intangible assets, from its assets and liabilities to its brand reputation and growth potential. Getting swayed by market hype without understanding intrinsic value can lead you to buy into bubbles that soon burst. While one investor gets swayed by temporary market euphoria, the wise investor dives deep into the underlying worth of a company, ensuring they're paying fair price for a real value. Number 7. Letting emotions drive decisions. In the turbulent sea of the stock market, emotions often steer the ship, leading even seasoned sailors astray. Fear, greed, panic, euphoria. These powerful emotions can dictate decisions, often leading to impulsive actions and regrettable choices. Enter Warren Buffett, the epitome of equanimity in the frenzied world of finance. Like the baseball player, Buffett emphasizes the importance of patience and clarity, advising investors not to let the crowd's mood dictate their actions. In the cacophony of market noise, it's easy to get swayed, but making decisions fueled by emotions? That's like setting your ship adrift in a storm without a compass. Keeping a steady heart and a clear head, especially during market upheavals, can make all the difference. As the saying goes, keep your emotions out of your investments. Remember, the market's short-term movements are unpredictable, but a calm, informed approach stands the test of time. Number 6. Ignoring fees and costs. Imagine a bucket gradually emptying, not because of one big hole, but due to several tiny leaks. This image, it perfectly depicts an investment portfolio burdened by overlooked fees and costs. In the adrenaline-fueled world of trading and investing, it's easy to focus on potential gains and overlook the subtle, constant drain of fees. For Buffett, understanding the full landscape of an investment means also being acutely aware of its associated costs. The difference may seem insignificant in the short term, but compounded over decades, it's like a silent thief in the night, stealthily eroding your hard-earned wealth. It's easy to get enticed by the promise of high returns, but savvy investors always read the fine print. It's there that the true cost of an investment reveals itself. It's not just about how much you make, but also how much you keep. And unnecessary fees? They're the opponent of the latter, Buffett says. As you navigate the intricate maze of the financial world, be diligent. Remember to factor in all costs. After all, it's the net return after fees and expenses that truly counts. Number 5. Chasing after short-term gains. The thrill of a race, the allure of a quick win, is undeniably exciting. But in the world of investing, betting on the fleeting sprint often means missing out on the marathon's rewards. We live in a world obsessed with immediacy. The get-rich-quick stories, the meteoric rises, they're captivating, but they're also deceptive. Buffett, known for his stoic patience and long-term vision, often swims against this tide. While the siren call of a short-term gain tempts many, he's more interested in the enduring investment's steady compounded growth. The volatile path might seem exciting, but it's fraught with risks and often leads to lost capital and missed opportunities. Conversely, the steadier path takes advantage of the magic of compounding, turning small, consistent gains into a mountain of wealth over time. In an age of information overload, it's easy to get caught up in the latest trends and buzzwords. But Buffett's strategy reminds us that investing isn't about chasing the latest fad. It's about understanding value and growth over time. Number 4. Not doing enough research. Just as a shiny apple can hide a rotten core, an attractive investment on the surface can conceal underlying issues. The key to avoiding such pitfalls? Thorough research. In today's fast-paced world, many are tempted to jump onto investment bandwagons, often fueled by hearsay, trending news, and charismatic pundits. Buffett, however, exemplifies a different approach. His investment decisions are never impulsive. They're grounded in diligent, meticulous research. Without proper research, investing becomes akin to gambling, relying on luck rather than informed judgment. The pages of financial history are filled with the tales of trendy stocks that fizzled out and seemingly sturdy companies that crumbled. Those who were buried often skipped their homework. It's clear, proper research separates the speculative gambler from the informed investor. It's the foundation upon which lasting investment success is built. Number 3. Overconfidence. Balancing atop the high wire of investing, one trait can prove perilous: overconfidence. Confidence is crucial, but can lead even the most skilled off course when it becomes unchecked. It's natural. Success breeds confidence, and in a bullish phase, it feels like nothing can go wrong. But overconfidence? It blurs vision, mutes caution, and amplifies risk. Buffett's wisdom, honed under the guidance of Benjamin Graham, has always been grounded in humility and a recognition of his own limits. Overconfidence often lures investors down the glittering path, but history shows that this road is fraught with unseen pitfalls. Time and again, investors' collective euphoria and overconfidence have inflated bubbles, only for them to burst devastatingly. The lesson? Stay grounded. Remember, in the world of investing, a dash of humility, a dose of self-awareness, and a constant desire to learn can shield you from the pitfalls of overconfidence. Always remember, the most important quality for an investor is temperament, not intellect. You need a temperament that neither derives great pleasure from being with the crowd or against the crowd. Number 2. Following the herd. The sheer power of a herd moving in unison can be awe-inspiring. But when it comes to investing, following the herd can often lead to unexpected cliffs and pitfalls. Markets can sometimes feel like a popularity contest, where investors rush toward the latest trend, fueling skyrocketing valuations. But amidst the noise and frenzy, Buffett offers a different tune, a call for independent thought and a resistance to the seductive pull of the crowd. The dangers of herd mentality in investing are stark, and the euphoria of a rising stock market. Many fail to see its true value or the risks involved, and when panic sets in, they sell in haste, often at a loss. Time and again, from the tulip mania of the 17th century to more recent bubbles, following the herd has spelled disaster for many investors. It's not about what stocks others are buying or selling. It's about the intrinsic value of a stock and its potential for long-term growth. In the intricate dance of investing, The steps you take should be based on research, understanding, and conviction, not merely on what others are doing. Number 1. Trying to time the market. The rhythm of the market, much like the swings of a pendulum, can be mesmerizing, but those who attempt to predict its every move often find themselves caught in a game of chance. Buy low, sell high. It's the classic mantra of investing, but the perilous pursuit of a perfect timing can lead even seasoned investors astray. Buffett's approach stands in stark contrast to the market timers. Instead of attempting to forecast market gyrations, he emphasizes a long-term value-driven strategy. The sea of investing is often tumultuous, filled with the short-term waves of optimism and pessimism, but trying to predict these waves can be a futile endeavor. Predicting the exact highs and lows of the market is a Herculean task, one often clouded by emotions, biases, and unforeseen events. As you navigate the investment journey, remember, it's not about entering or exiting at the perfect moment. It's about holding quality investments, understanding their value, and giving them time to flourish. So, remember these lessons from Warren Buffett the next time you're about to make an investment decision. Understanding and avoiding these common mistakes can pave your way to more informed and strategic investing. Thanks for watching. If you found this video valuable, don't forget to like, share, and subscribe for more insights from the world of finance.